Welcome to Life, Death, and the Law, presented by the law firm of Deason, Garner, and Hansen, hosted by attorneys Sean Garner and Adam Hansen.
That we have here Carolina and Gonzalo from Trilogy Financial. Their home base is in Scottsdale, but they come down frequently, at least once a month, to Yuma, Arizona. Carolina, you have family down here. Gonzalo, we do a lot of business together, and so it's just been a great fit to work with you two, and I'm excited to have you on the show. So I don't know if Carolina told you, but what I'm interested in talking about are the main issues that are wives' tales out there that people think are these easy ways to invest that are hidden gems out there, and the main public doesn't know about them, but they're ways to avoid all these taxes and to get exponentially more interest. For example, investing in whole life insurance and then borrowing from the life insurance because it's tax-free, never paying it back, but on your death, the policy pays out, and that's an option to save in a way that's similar to like a Roth IRA, but you don't have the limitations that a Roth IRA has. So, in fact, I had a neighbor come up to me just the other day and say, hey, I'm having a financial advisor come up by my house, and I want you to be in there and sit in and just kind of listen to the discussion that he has. He's telling me about these great ways that he can save a bunch of money and help me invest through whole life insurance policies. So that's one of them that I've come up with. I'm sure you hear different things all the time, but what do you say to those types of things? Is that valid? I know Dave Ramsey, who is a sponsor of this show, hates that idea. I've looked into it myself. I was a insurance licensed agent in my prior life about 25 years ago, and I was sold on that idea when I was about 22 years old, but have since been more, I say, disabused with the concept. But what's your take on it?
Well, that specific issue, let's just take a step back. Normally, when somebody comes to us with that specific, let's say just one of those gems. Let's just describe it first like one of those.
Yeah.
We will go to the whole life later, but let's just talk about that miracle silver bullet.
Mm-hmm.
Normally, when somebody comes to us, first off is the source of the information. It's never reliable. And when that source of information will give you a very perfect scenario, everything is perfect, and that will work. So when somebody says, is that possible? Will that work?
Mm-hmm.
Sure, it will work if you keep it in the lab and everything is controlled and everything is perfect and you always do all the paper and everything just perfect. You said it in your seminar. Well, life has a funny way to not be really perfect. So you're going to stop making certain payments. You are not going to be alive when that, whatever that is. So that just little ingredient is missing. It just collapses the whole strategy. And that will be with whole life and all these different kind of strategies. Normally, that's the way that it's sold to somebody. And I'm using that word specifically. I don't like it because that's not what we do. We don't sell anything. Just like you were not selling something.
But you do offer life insurance. You offer life, term life. You offer whole life.
Correct.
Variable annuity life.
All those things.
Okay.
But it has to be a very specific scenario, a very specific need. Like you don't recommend leaving trust for every single person that walks through that door.
Mm-hmm.
If they don't need it, you don't do it. Right?
So let's say I'm interested in that. I say, Gonzalo, I've heard this whole life policy is the way to go to save when I invest. It's going to be after-tax money that I'm investing into it, but I can borrow tax-free, and then anything that's left over in the policy is going to be paid out to my beneficiaries tax-free. Find me a policy that's going to work for me. What's your response? I want to save up. Let's say I want to put $100,000 into it, and then I can borrow. So the scenarios I see on the internet all the time, I put the $100,000 into it. I can borrow the $100,000 back, and I still have the life insurance policy. Is that true?
You see how you're leading to that question. I don't know. The answer is I don't know because I don't really know that scenario. I need to know around it. What's happening? You have more retirement assets. Do you have a home? You have kids. All these things I need to know to make sure that that specific scenario will work for you.
Okay.
That is the problem. When somebody goes online, TikTok or YouTube, whatever, whatever podcast, it's a very specific problem and it's solving a very specific issue. Right?
Yeah, so usually when they come to us looking for a very specific product, like you said, what we do is like, okay, let's sit down. We go through the whole process, like ask them the questions, create the plan. And honestly, maybe only 1 out of 10 times that was the product that actually fits them or it's the best for them.
When you play out all the scenarios and you show them the reality of the scenario. For example, one reality that I've seen, because I do have whole life, and why I got into it, I can't remember because it's been probably 20 years. But I do have a couple whole life policies. You guys are my advisors. You know of those policies, and you're permitted to talk about them, so go for it. But I know that I can't borrow as much as I've put into those policies. So the concept that I can go out there and buy a $100,000 policy and then borrow that money back and use it while the policy is still in effect, I have not seen a policy like that. Normally you can borrow up to 80% of the cash that you've put into the policy. I've never seen a policy, and I don't see them as often as you do, but I haven't seen a policy where you can borrow 100% of the premiums that you've paid on the policy.
It's all about timing. Everything is about timing and how much you fund that policy. So let's play with that scenario. Let's say this works. Let's make it work in this case. So you will start 20 years ago. Let's say 20 years ago.
Yeah.
And you normally overfund that policy. When I'm saying overfund is and again, I'm not going to say whole life because there are different kinds of whole life, index, universal, variable life. Let's just say something that builds cash for this conversation. So normally it has minimum premium, it has target premium, and it has a limit pre-MEC, modified endowment, and that's a range. So people that want to do that kind of scenario, like you're saying, overfund the policy more than the minimum, more than the target, and very close to modified endowment.
Okay.
So you're pushing a lot of money into this puppy, whatever that solution.
Yeah.
Now, and we need time. We need consistency and time. So as we keep doing that, now the policy people will describe it as equity. You're adding a lot, and your risk gets smaller and smaller because the assets that you put in, the insurance company is not in the hook for this thing. Let's say you're protected for $1 million, and now you overfunded so much that your premium plus the interest that you're making, whatever version of that is, now is covering your risk, but only for that specific amount. Let's say you're insured for $1 million, and now the policy is $500,000 in money that you put in.
I put in $500,000 paid up premiums.
Okay. And the interest rate, whatever, everything. Now your risk is only $500,000. You're still paying the premium for $1 million. Right. So as you keep doing that, now we're adding that up, and there's going to be time, like 20 years. You're saying 20 years. I don't know exactly when, depending on age and all that. That your risk will keep pushing your death benefit. There are rules for that. And I would say 10, 15 years that you're doing that, now you will have more money that you invested in, and you will have the life insurance plus interest, and that will work. But you see, now we extended for 15 years. We were overfunding for 15 years nonstop, right? Nothing happened to you, and you kept doing that. That works. Those scenarios that are on TV or whatever on the laboratory of YouTube, that works perfect on paper, right? The problem is when people stop paying premiums, do they want their money back in 5 years because they have hardship or whatever? They stop paying for 5 years because the policy will be alive, even if you stop paying that. Or they forget what is this tragedy, and they reduce to the minimum.
Yeah.
By the time you remember 20 years in the future, I want my money back. This is what you told me. Yes, but the conditions have to be A, B, C. You only met A. So that scenario won't work.
So for the premiums, I don't know. I'm sure every insurance company has a different calculation as to how to determine what they're going to be requiring for the premiums, but it's going to be something above what the total value that you're putting in. So let me just give an example. Let's say I want this $1 million policy, right? And let's say that the market does 5%, and that the 100 or the $1 million is invested in, and the premium, right, is also 5%. So really, because the company needs to make money, right? That's their premium. That's what they're charging to keep me insured, and that premium then negates any of the growth. Does that make sense? Isn't there going to be a premium that they're going to require? It's not just I'm putting in the money and they're going to say every dollar that you put in, you're going to have access to. We get paid whatever it is, 5% broken up over a course of a year as the premium to have this policy.
Yeah, I think I getting your question. Normally, there are charts, and they're not just they're not owned by only the. There's expenses like mortality rates and things like that. Actuaries have these charts, right? So normally your premium has to cover your risk, just the risk as is, right?
Yeah.
I'm 30 years old. I'm not 30 years old. I know I look at 30 years, but I'm not. And then I'm covered for $1 million, right? There's a specific number, to your point.
Yeah.
And then the rest will go to these accounts. Now, again, now we're splitting hairs because there are different kinds of, let's say, cash values or whole life. And that's when things get really interesting. Because when somebody comes to me saying a whole life works in a different way than an index universal life, than a variable universal life. And it's all about how much money I'm making, how.
Yeah.
So the really popular one, whole life, nobody uses that anymore. The index universal life normally will put money in an index, let's say S&P 500 index.
Okay.
And the insurance company will say, okay, so every year I'm going to give you credit for whatever the index does.
Yeah.
Okay, great. But it has a cap. Who makes money, right? You're asking how is the money, how are the money's being made? Okay, so you will have, at least I will give you 3%. That's on the insurance company.
Mm-hmm.
But the max that you can get is 9%.
Okay.
Okay. Last year, the market was up, I don't know, Google it, but like 20 something.
Yeah.
So that was a big margin for the insurance companies. Ching, that goes there. And then for the years that the market is under or flat, well, they're only on the hook from 3%, right?
Right.
Now, I'm giving you specific numbers, but each company will have different caps, okay?
Yeah.
Could be 13. And anyway, so when somebody says like, who's making money and how? Well, the insurance company is getting paid for your risk.
Mm-hmm.
That's minimum. Remember we talked about that. And then the other thing, well, they're making money on that differential of your cap, and then whatever the market did.
So they're getting paid the premium based on your risk, and they're minimizing how much money you can make by capping the 9%, and they're going to reap the benefits of the difference. But they're also limiting your risk because there's not going to be loss, but in the long run, the numbers always favor the house.
And that makes sense. It's a business at the end of the day. So, we take care of a lot of elderly and senior citizens. And when you ask them, what do they want? They want certainty.
Yeah.
They want that they are willing to say, I don't want to make 22% in the market. I don't want to lose. I'd rather have 3%
Yes.
positive than negative whatever. So I'm okay giving up and that's what I'm saying. That tool, you keep saying tools in your seminar. That tool works specifically for somebody that has that need and wants that.
And it's a life insurance type tool.
Correct.
But really, isn't it? It's a life insurance company that's selling an annuity contract, right?
The chassis is the same.
Okay.
You're right. I like to say that the chassis is pretty much the same.
Okay.
The risks, annuities, and life insurance, that's why you can exchange it. You were talking about it. You can exchange, how's that the order? You can exchange an annuity, life insurance to an annuity, you can do that because since IRS, it's fine with that and all that because it's the same chassis that
Yeah.
you're saying. It's just different bells and whistles. It's like I'm saying, I drive a car. Okay, which one? It doesn't matter. I'm just driving a car point A to B. Okay, but if I have more bells and whistles, the life insurance will have different features than an annuity and all the riders and all these things is when things get really complicated.
Right.
When somebody says the gem, right? We go back to the initial point. Oh, this is the gem. Maybe for me or my mom, because she had a very specific situation, but not for you or your family, right?
Okay. What's another misconception that is frequently brought up to you as far as them hearing it on the internet or TikTok that, oh, I know people make a lot of money this way. Can you help me invest in this particular manner?
We were talking about it and we thought of a couple. One of them was that you should pay your mortgage as soon as possible, and that would help you create more wealth over time. And sometimes we actually disagree with that point.
Okay.
So
'Cause Dave Ramsey often advises
Yes.
for that. And so it's I think it's important to discuss that it's all unique based on the individual. So when do you part with that type of advice?
Yeah, so it's definitely, like I said with the life insurance case, it's definitely depends on the individual. So there's no advice that would cover everyone or would be good for everyone. In terms of the mortgage, it really just depends on your interest rate, but also in everything else. You know, how much do you have for retirement? How much do you have in savings? Like everything else will affect our decision if we would say like, yes, pay it off or not really. So it really just depends. But I think a huge misconception is that, yes, everyone should pay it right away. And not really.
What's the downside of paying off a mortgage if I have the cash?
So sometimes we see cases when someone has a very low interest rate, for example, 3%, and they're young, they could easily just invest that money and get an average return of 8 to 10%. But if they pay the mortgage off, then they lose that liquidity, they lose the options they have. And in the long term, their net worth it would be lower because they would be saving that 3% instead of winning the 8 to 10. So that's a case we see a lot. Yeah, last week we had a case like that.
But you keep a lot of different points, Sean. When somebody says that, you said Dave Ramsey says that, well, hold on. Dave Ramsey has a very specific order of things.
Right.
So if you jump directly to pay my house sooner, sure. If you already have A, B, C, D, and then you can do that. And it's funny because clients will come to the office and say, well, I follow Dave Ramsey halfway. And you see, this is when things it's like following your advice halfway. Like, well, my advice won't work if you just follow it halfway. So a lot of people say, well, I follow Dave Ramsey 50% of the time. And like, okay, that's interesting. So, for example, I will, use my credit cards, but then I don't trust this, just like Dave Ramsey, but I use, because I am smart and I know how to use it and I know how to play. Anyway, going back to the gem, all those tools have a very specific order of things and it works if you follow everything specifically, right? I have another comment that people normally come to me saying, can I have my own 401k? And it's called self-directed 401k. So I can invest in whatever I want and all that. Oh yeah, in the laboratory, that's perfect. That's great. But there's a lot of different things. Like if you own real estate, you can paint it because you're adding contribution to your IRA that you're not supposed to do. You're adding value. And there's different caveats. So you need to be very specific. There's a big yes list, no list. And if you just exchange them, that's a nightmare, right? So can it work? Yes. Have you seen it work? No. Most of the people won't follow the recipe. And their cake is just horrible.
What happens when you violate those self-directed like IRA rules? I've seen that a lot. Clients will come in. I'll use a scenario from California. They came in, they have properties in a self-directed IRA that they put in there because they were trying to do their own thing. And they were trying to do something. I don't even remember what it was at this time. And it's like, I'm pretty sure you can't do that. That's against the rules. And they're like, well, nobody ever told us. So what happens? Who's policing it? The IRS?
The IRS will knock at your door, and first off, you need to think about it. Like, okay, so you're overfunding your IRA. Let's say it's just a normal IRA, the same rules. So let's
So
say
you say overfunding, you're saying in this particular year, I put more value in that I'm allowed to.
correct. Okay, so now picture this nightmare. Let's say that happens 5 years ago. Okay, so now you need to take that money back. How am I going to do that? Now it's a pool, or now it's a whatever in my house,
Yeah.
right? Okay, so now you need to have people that will evaluate that, go back, put it in, and it's just you need to change taxes each year. I mean, it's just really a nightmare. And whatever you saved in taxes or whatever your gem of the solution, now you're paying attorneys and all to represent you in court or the IRS audit, all those things, just because you did not follow that instruction.
What if you don't
One case,
tell them that you have a pool?
what was that?
What if you don't tell them I have a
The
pool?
IRS?
Yeah. Are they coming to my house and looking for pools and upgrades in my house?
No, I understand your point, but you see, sometimes this is what we found. And we're not accountants. We speak accountant very well, but we're not accountants because we deal with a lot of small business owners and we need to communicate we translate. But the IRS has like little seasons. I don't know if you know this or you will capture this, but I don't know how many years ago they went after waiters and waitresses for their cash. And they just hone in and audited that kind of, I would say, people that will put their income like that. How, why, or don't ask me. I don't know. But they will find specific niches. So they may easily say, now let's audit those self-directed 401ks or self-directed IRS. Let's see what we find. Just because whoever in charge decides now we are going to find money there. And they will do. As you know, once you get an audit, they will find that forbidden transaction, how it's called, and they will fine you for it. So that's how now, when is that going to happen or how? I have no clue. But if there's enough money there, I'm sure the IRS will knock at your door.
Do you think it's political?
I think that when they need money, they just see what is the next case, right? Like grandma with some money in the mattress. I don't think we will find a lot of money, maybe. But how about a trust? I don't know. Maybe they're going to audit trustees or something like that because they can. There's money to be made. We like it or not, but that's the way it is. Just like the Medicare.
Like a shakedown.
Yeah, just like the Medicare rule. Well, not rule. The employees.
Yeah.
Rule, right? It's just the way it is.
Do you think it's a good rule? Should we be taxed?
Yeah.
As citizens?
There's currently discussion about getting rid of the income tax. What do you think about that? And I guess more generally, if you don't have a specific opinion on that, the way the country is going fiscally and how they're trying to doge in the program of eliminating government waste.
Have you heard of that? Like
I have heard
the
of
Trump
that.
administration's throwing around the idea of no income tax?
Yeah, I have heard of that.
What was your first reaction? Like, that's crazy.
We haven't heard of that, but listening to it right now, yes, I think that's crazy.
Mm-hmm.
Why though? Why do you think it's crazy?
This is just what I think. Everything goes back to behavior.
Uh-huh.
Just behavior, right? And okay, so let's just assume there's no income tax. Let's just play with that scenario.
Yeah.
Okay, let's play. So no income tax. Where's that money going to? The income tax. I'm asking this question to you. Where do you think it's going?
Government programs,
Okay, such as
USAID.
okay.
Yeah.
Name one. There's thousands of
Yeah.
agencies.
Department of Defense.
So we
Trillions
start
of dollars.
trimming all those things, right? And we keep it close. I am positive that a lot of programs are useless or wasting a lot of money, but I'm not saying everything.
Yeah.
So when people come up with these solutions, they're always thinking in absolutes, all or nothing. Well, how about we just pay attention in these agencies? Maybe we don't need that one. Maybe we don't need that one, but we need that one, and then we just start cutting and just be more efficient rather than just say all of nothing.
Uh-huh.
Because when you're dealing with absolutes, you just lose me, you just lose me right there on that proposal because no, that's not how life is. You're not dealing in absolutes in any circumstances. Like that strategy works or not.
Mm-hmm.
That's not the way.
Well, and everything seems to be political. it didn't used to be. I know that vaccines, it was only the hippies that didn't want to get vaccinated, right? It wasn't a party. It was a choice of, I'm going to live natural way and my kids are going to just develop natural immunity, and so we're not going to get vaccinated.
You're going to offend all of our hippie listeners.
That's okay. I offend a lot of listeners. And then it became a very much, if it's Trump supported, we're not going to do it. For example, prior to the 2020 election, when the vaccine was being pushed really strong as far as the development of it, I think they called that Operation Lightspeed or something like that. And they were developing the vaccine very quickly for the COVID-19 virus. There's a quote for Kamala Harris that says, "I'm not taking a vaccine that's developed by the Trump administration." And then when Biden got elected, then it was not only highly, highly recommended, but required of government employees, and they'd lose their job, and it was required of military personnel. And so it seems to me that it's this Trump derangement syndrome. If Trump liked it, I hate it. And if Trump doesn't like it, I want it. And so therefore it's political. And I think the same thing is occurring right now, where most people, when asked in a vacuum if they want to get rid of government spending and government waste, they would say yes. But because it's happening under the Trump administration, and we're seeing, even when they're saying all these ridiculous things that are being cut from U.S. aid and so on, they're saying, well, this is ridiculous. These guys they're acting like tyrants. They're acting like dictators. Nobody elected Elon Musk. Instead of saying, well, it's a good idea to cut those things that are wasteful spending. So I guess my question to you is, do we ever get back to, and do you view like the financial atmosphere for the United States that way through politics, or do you just look at the dollar and cents of it and say, okay, I'm neutral, this works financially, this doesn't work financially?
Good question. And we don't watch news. I can't.
We don't watch the news in the office, so it's very neutral. It's just like,
And the reason,
Do you guys talk politics in the office?
no,
never.
What do you mean you don't watch the news? What, like this is a personal choice or like a mandate in the office?
no. Okay, I don't control what Carolina
Yeah, but
watches or not. But this is, go ahead.
no, that's what I was gonna say. I think it's a coincidence that we both agree on that, but it's not like a rule in the office.
It's just because subconscious, I cannot do my job properly. My job is to make sure people make good financial decisions.
Mm-hmm.
That's my job, and that's what people hire me to. Not to vote for whatever or cheer for one or not cheer for the other.
Uh-huh.
Is that going to grow your money in your bank account and you will have a legacy larger? I want that.
Mm-hmm.
Now, who is supporting what is irrelevant for me. So the news will taint your decision-making process. That information, even though you believe it or not, in your subconscious, you're acting on that information. So when I know those stories because people tell me those stories, but not because I see the headlines or whatever. It's really, I'm giving a disservice to my clients if I'm being brainwashed by any channel.
Yeah,
right?
so driven by
Fox
the news.
or CNN or everything in between. I don't know the agenda of whatever. I can't do that.
Well,
So when I see a client, I need to see, or we see our client, we need to see their current situation and then what triggers that person. Are you going to just go crazy in a credit card? Forget about who you vote for. And I need to change that behavior in something that you would do, right? I'm not going to throw you to the deep end of the pool if you don't like to swim, but you need to kind of get your feet wet, right?
Mm-hmm.
How, in my head, I need to be very clear on how I'm going to make my client to make the best financial decisions for themselves and their family. The news won't help me at all. It won't help my client. It won't help me. It won't help me in planning. In planning, in my software planning, we don't have, if Democrats win, go this. This is a decision tree. If Republicans win, just go somewhere else. That's not the way it works because we don't control that. You see, we talked about that last time. We don't control who wins. So we don't control if income tax is gone or not, or what agency is going to disappear. What I control is how much you save every month, and what do you do with that when that hardship happens. Are you going to tap into your 401k? Are you going to sell your Polaris or your boat, or you're going to tap into the 401k of the kids' college? That's the things that we control, and my clients control. The rest is just an illusion. They don't control that.
Are you doing a lot of trades for clients? So what I mean, or what I'm asking is, that would come into play if, for example, the Biden administration, they're going to be all solar and wind and all these things. So maybe you make your portfolio heavily towards those things. Whereas when the Trump administration got elected, a lot of people put their stuff back in oil because it's just going to go bananas, right? So it has some effect, I would argue, as to what you're putting your money, what commodities, if you're going to go more commodities or you're going to go more real estate, for example, in your portfolio. So are you making decisions? How do you make your financial trade decisions?
Take that one.
Sure. Well, we have an investment committee,
What? An
investment committee full
committee.
on what's going on in our portfolios. And we talk to them all the time. And what I see they do is they focus more on like economic factors or what's going on in the economy. And I agree with you. For example, they recently talked about how international investments were not doing that great recently. So stuff like that, but they never talk about it as political.
Mm-hmm.
They were not like, oh, because this person won, international is not going to do well. They're more like, no, like we've seen it's not working. So maybe a little bit less in our portfolios or stuff like that. But it's never political, to be honest. Mm-hmm.
Now, remember, this is just to give you another, and for everybody that's listening, we're talking about our firm and the way that we work. I'm not saying that that's how your advisor or whoever will work, but we have different portfolios. Remember, decision making. Just keep that in your head. So we have different portfolios that will do different strategies, different points of view. Let's say that. So the traditional, efficient frontier, you don't mess with that. You just say how much risk I'm taking, what is the rate of return. We're trying to find that it's not perfect. There's a line between risk and reward. Let's find that spot. That's the traditional way of investing, and people like that. Let's say you like that.
Mm-hmm.
But you want me, the same advisor, you want me to very quickly and pay attention to all these things that you're saying, who got selected, who got elected, who got what contract. Well, there's another portfolio that does specifically, that. It's more like a tactical. In fact, we call it tactical. Is when you're paying attention to those things.
Mm-hmm.
Right now, you may not want that kind of speed and that kind of trading because it will make you nauseous.
Yeah.
But you will love it. That's what you want me to do. Right?
Because the bigger the risk, the bigger reward is the idea, right?
And so for our audience,
not necessarily.
yeah, because some people only listen to this show. They don't get the full YouTube version of it, and they're listening to it on the podcast. So you're looking at Adam saying he is risk adverse. He just wants to grow steadily, and I'm the one that wants to do the day trading because I'm looking for certain industries to boom or bust, and trying to get you to trade on that. So when you say you and you.
I thought it was okay. I understand.
Yeah. So for the podcast listeners, Adam's a conservative one. I'm the one that looks towards industries that I think are going to thrive, and I want you to invest in that industry.
Correct. Thank you. Yes. Now I know they're not watching.
Yeah, well, they should be.
Okay. So yes, you see. So now each one of us will have it. Going back to decision making, what happens when the market tanks? You want your money. Adam wants the money out. Sean wants to put money in. But at the same time, what is the best solution? I don't know. I need to talk to each one of you, and what's your feeling for that? So sure, we have a committee, but then we have different portfolios. Like we have one that is run by algorithms. People sometimes love that. So there's not even opinions. It's just risk, reward, trends, and it's a software making decisions.
Yeah.
Now there's somebody that loves that thing because now the advisor feeling guts and all those things they're out of the picture. It's a machine making decisions. I trust that. Other people say like, no, I don't even like AI or any sort of, I don't even have a phone, right? Just give me the traditional buy and hold strategy.
Yeah.
At the end of the day, I want them to save as much as possible and make the good decisions, right? So I'm not pushing a specific strategy, to your point, and I'm just saying such and such is going to win. We need to change. We need to trade to blank. Maybe somebody wants that, but Adam won't.
Right.
Makes sense.
Yeah.
So I know the answer was I don't. The answer is I don't.
Mhm.
Not all the portfolios kind of pivot based on who gets elected and all.
But it sounds like some do. So some are going to be vacillating according to political spheres. You're not into the political thing, but you've got people in the committee that are looking over what's going on globally and what's hot, what's not.
Correct.
And let's be more risk adverse and put heavier investments into this chunk of industry in this portfolio, because that's going to tend to weigh out the bad over here in this other industry that might go down because it's this particular president.
Correct. And now, if you tell me which one is the best, it never work. I can't tell you because each year is just different. Each year, the one that says buy and hold, the old boring way to invest, that was the winner. And then the year before, the one that is super aggressive and super active, that was the winner, right? So what strategy is the winner? Again, it doesn't matter. What do you like to see in your portfolio and how do you like to see your money grow? That's the most important decision-making piece of information than everything else.
I'm curious to know like the result, and maybe you don't even know this, but the result of the algorithm one, like, does that tend to do better than humans, or we don't know yet?
It did for a couple of years and it didn't. So
It goes back and forth because I've heard that same thing. It's like I could open up, what used to be the Wall Street Journal. I don't even know if it's printed anymore. And if you pick this stock and I'm going to pump tons of money in it, and that probably would do just as good as me, like doing all this research in this particular company and putting a ton of money in it. I've got 2 stock tips in my life. One was from my dad. That company went bankrupt. And then I got one from Sean here.
It's doing good, but we
Is
sold.
it? I haven't looked.
We bought high and sold low, so.
Okay.
But it's doing good now.
No, you see the one. Let me tell you what happened with the one with the algorithm working. It's very weird when stocks and bonds go down at the same time. That happened. I don't know how many years ago. I don't know, 60 years ago. Don't quote me on this, but long time ago.
Mm-hmm.
So the programmer's like, well, that's not going to happen. Well, guess what? It did. So in the last 2022, 2023, both things went down. The software did not compute. You know programming. Both of you understand that. So that scenario was not in the programming. So, okay. And then he stayed flat. He did whatever he's supposed to do. And then he was waiting and waiting and waiting and waiting because the programming was not giving the right signals. And then November 2023, it skyrocketed. And the software said, like, that's not normal. Again, that's something that I've never seen. Mm-hmm. And it just went like this pretty much and kept going. And the software said, like, well, something's wrong. This is not real. And then 3 months later, it is very real, man. So you just stayed in the sidelines. That's software. I'm talking to a software, right?
Mm-hmm.
You stay in the sidelines for 3 months and that jump actually happened and he stayed for good. So that year, that software portfolio really sucked.
Because software can't anticipate innovation, like what's going on with AI and how quickly that's going to be incorporated and how it's going to affect businesses. And the next invention that who knows what it is yet that comes out, the software doesn't know what that is and therefore can't calculate whether or not to buy or sell stock in that innovation.
But you know who loved that portfolio? Senior citizens. Because the
algorithm?
Yes.
Oh.
Because he can go to cash, all of it. And it just detects certain market crashes, specific thing, and they prefer
sells it off. Okay.
Sells it off. And if it's in an IRA, you don't need to worry about, capital gains or anything like that. So, believe it or not, you will say like, what? Who chooses that? Well, somebody that prefers that, not emergency brake, and just go to cash. Cash is a player in that portfolio. Sometimes cash is better than stocks, and he's making more money than stocks just because whatever. We won't go there. But the people, you tell me who stayed in that portfolio, the kind of 75, 85, they love that portfolio for that strategy. And when everybody was crying, because the market went down, they were really happy because their portfolio was only down 5% versus everybody was down 15%.
Right.
Not losing as much as winning, right? So they were happy. Just unexpected for us that market will love that.
What I would love to do is just do a role play for maybe 5 minutes, maybe 10. And I know that it's very difficult as a financial advisor, just as it is an attorney, to give specific answers, okay? But let's play along here. Say that I'm a 40-year-old, right? I've got 2 kids at home. One is 10, one is 8. I make $100,000 a year. My wife works. She makes $100,000 a year as well. For our needs, we only need $150,000 to maintain our lifestyle. And we would both like to retire when we're 60. So we're both 40 years old. We'd like to retire in 20 years. What do you recommend? And I know a lot of our clients out there, they'd like to hear some specifics. Even though this scenario may not match their scenario, they'd like to hear how the interview process goes. So what would you recommend, Carolina? Where do I start?
Well, with that whole situation, obviously that conversation would take like 45 minutes to get all that information.
Okay.
But what about other assets? Do they have retirement accounts set up already?
I live in a home. I owe $250,000 on it.
Okay.
It's worth $500,000. I've got 2 cars. They're worth together $100,000. I owe $50,000. And I have $50,000 in savings right now.
Okay. So no retirement accounts.
I don't have any retirement account. I know that I need to get that going, but up until this point, I've just been trying to keep my head above water. I'm finally at the point where I'm making some expendable cash.
Okay. So yeah, I think the first thing we would be setting up retirement accounts, since you mentioned it's an important goal of them to retire when they're 60. So that would be one of the first things. Set up retirement accounts for both of them. Make sure they invest, at least 15% of your income. But you said maybe they could invest a little bit more.
Yeah, they could invest 25% of their income because they've got 50% that is not necessary to maintain their standard of living. They're making their car payments. They're fine with that. Their interest on their car payments is fine. The interest on their mortgage is fine. Well, let's just take all those variables. What do I do with the $50,000 cash? Do I put it under a mattress? Do I invest in gold? Is that safe? Or what does the portfolio look like that I'm investing it into? And I'm not asking for a specific stock, but
yes,
it would be put into a portfolio. And what type of return can I expect from that portfolio? What should I be aiming towards?
Time out. First off, we need to protect them. Before we do anything crazy or portfolio, something sexy or whatever you want to do,
Bitcoin.
I'm going to ask, do you have a living trust? And this is a true part of the conversation.
And that's why we like you guys so much.
Yeah, do you have a living trust? And do you have life insurance?
Okay.
If the answer is no, you need to get a living trust because now you have a mortgage and a house.
Mm-hmm.
You have 2 kids, so we need guardianships. We need to protect them somehow.
Yeah.
And right? And then life insurance. Life insurance today, I'm not gonna go over that, but life insurance today, forget about which kind. Life insurance today will protect you for more different things. If you get ill, you can get your life insurance. And we won't go this specific to that. But very quickly, your state can go from just $50,000 to $1 million like this. And we need state planning to protect that. And not just because you're here, because what you do, that's a basic question. If they don't, some of that money, please get a state plan.
If you have questions or want to know more about something that was discussed today, please call the law firm of Deason, Garner & Hansen at 928-783-4575 or visit yumaestateplanning.com.